Hello guys, how are you guys doing? It's your boy Everest FX, and today we are going to be talking about forest risk and money management. So this is a complete master course on both forest risk and money management in trading. So we'll first be talking about introduction to money management, and next we'll talk about understanding risk, and then we'll talk about position sizing formula and risk to reward ratio. We all know that RR. And next we'll talk about money management principle, leverage and margin management, emotional and psychological control, practical application, risk plan, and then checklist and habit. So now let's start with introduction to risk management. So now the first question here is, what is risk management? Okay, in a very simple term, risk management is just the act of managing risk or managing money in trading. Okay, one of the major problem of most traders, especially the beginners, they just learn strategy and they won't learn risk management. They just go into the market with any lot size and they end up losing their capital. So risk management is the process of identifying, assessing and controlling the risk of losing money in trading. So now the question here is that is this: why traders fail? Most traders fail from over leveraging, using high lot size without proper risk management, no stop loss discipline. Some of them even do revenge trading. Also, we also have risking more than they can afford to lose, not understanding position sizing. So most traders, they risk more than what they can afford to lose. There is a saying that any money you are not ready to lose, don't put it in the market. While most traders trade without stop loss. So these are most problems of traders. Okay, so in our module 2 we have understanding risk. We have understanding risk here. Now, type of risk. The first type of risk we have is market risk. Don't worry, I'll just summarize all of this and then we'll go down to the main topic, the main reason, okay, how to calculate risk and all of that. So we have market risk, we have leverage risk, we have liquidity risk, psychological risk, and event risk. Market risk is just trading volatile pair. So they appear like gold and other pair that are high volatile. So that is why you see most mentor will tell their mentee when learning, stay away from gold, stay away from this pair, because they are very volatile. Gold can blow your money in a second if you use a very high lot size and you have low capital. Just in few seconds, gold can blow the whole capital. So that is market risk. Now when we are talking about leverage risk, now leverage itself is borrowed capital. Okay, here I said using borrowed funds increases both gains and losses. Leverage itself is like a borrowed funds or a borrowed money that the broker lend you in order to open much position. With your $10, $20, $100, even $1,000, there are some positions that you cannot open. But if you have high leverage, you can open a lot of position. So next we have liquidity risk. They say inability to close a trade quickly at a fair price. So most traders don't know where they're supposed to be targeting. Mostly you see the markets going your direction, let's say like this. So mostly you see the market tap you in like this. The market is going your direction and maybe there's a liquidity here. The market will just sweep the liquidity and come back and take you out. So most traders don't know where to leave the market, when to leave the market, because of lack of risk management. So we also have psychological risk when it comes to emotion, fear. We also have event risk like news, NFP and all of that. There are a lot of traders that don't trade news. So during those news period, they just stay out of the market. And most newbie don't know anything about fundamental analysis. So that's it. So now, if we talk about risk per trade, you need to know how much to risk per trade. Now, a very simple rule says that you should risk 1 to 2% of your account per trade. That is, if you have $100, you should at least, okay, let's just say $100 is small, but for example purpose, let's say $100, you should risk 1% or 2%. That's $1 per trade or $2 per trade. Okay, I'll not talk much on this. Let's go down to position sizing formula. Position sizing formula. Now, in order to calculate your position size, you need to know lot size. So in our previous courses, I think when we were talking about Forex for beginners, we talk about lot size, where we say we have standard lots, we have mini lots, micro and nano lots. So your standard lots is one lot size is your standard lot, 0.1 is between 0.1 to 0.9 is your mini lot, and we still have the micro lot. Most brokers don't offer nano lot, so I'm not going to talk about it. It's only those people that trade all those volatility pair like index and all of that. Those brokers usually offer nano lots, but on a normal sense, it's just from micro lots upward. Okay, so now to calculate your position size, let me bring a very simple example here. Now let's say I'm buying here, and this is my stop loss here. This place is my stop loss. So this is my entry, this is my stop loss, and this way I'm aiming for. Now let's use this example here. Your account is 100. Your account is $1,000, sorry, and you want to risk $20. Yeah. Now, a very simple way to know how many lots you should use is you just get your calculator. Since you want to risk 2%, that's $20 of this $1,000 here. Sorry, let me get this. Okay, you want to risk 2%, which is $20, right, of $1,000. Now you just open your calculator and you do 1,000 like this. 1,000 divided by 20. 1,000 divided by 20. What do we have here? 50. Now this 50 you have here, let me write it. You have 50. Okay, I need to go back. I made a mistake and changed this. Okay. Now we have $50 here. Now this $50 that you have here, it is in dollar, but 50, when we are talking about $50, how many units is $50? One lot size is $10, so it means that 5 lot size is $50. I don't know if we understand. These are your lot size here. We have standard lot, mini lot, and micro lot. So let me give another example so that this will be very easy to understand. Let's say you want to risk $500. So we have $500 here. Now, and your stop loss PIP. Your stop loss PIP is $40, for example. You just do 500 divided by 40. What do we have here? We have 12.5. Now this 12.5 you have here is in dollars. So let me write it. We have $12.5. That means you are risking $12.5. Now if you want to now enter this trade, what you should do is this. Since you know that one standard lot, a standard lot is $10, so automatically this is automatically 1.2 lot size. this is automatically 1.2 lot size. So let's use the formula and see if this is correct. Now this particular calculation I just did now is more of advanced, because when you want to enter a trade, let's say price is already coming down to your entry, you will not start doing a very long calculation. You will just simply go to your calculator and just calculate this very fast and set your limit. Okay, but let's use this is the formula here. This is the formula here. Let me delete all this. Sorry. Let me remove this, and this. Okay. Now, the formula said risk percentage divided by stop loss pip times pip value. So, if you have $1,000 in your account and you want to risk just 10% per trade, so it's a 10%. I want to risk 10% per trade, and how much is 10% of 1,000? That's $10, right? 10% is $10. So let's say $10. That means we are risking 10%. Now, this is your trade here. This one. Let's say you are buying. This is it here. You are buying. Now, this is where to see your pip. Here. Down here. This 11.9 after this bracket is how many pip you are risking. Okay, while this 7.1 above is the amount you are going to get. So now we want to calculate how much we are going to lose if this trade eventually hits our stop loss. So our stop loss is 11.9 pip. So let's just say 11. Now let's use the formula. The formula is risk. We are risking how much? How many? We are risking 10%, which is okay. 10% is $100. Sorry, I'm supposed to use 100 here. 10% is $100. So 10% here is $100. So let's apply the formula now. Our risk is 10%, which is $100, right? So let's put 100. Now divided by our stop loss pip is how many? 11. So divided by 11. Now times 11 times pip value. The pip value they are talking about here is one standard lot. One standard lot is 10. So any calculation that you are doing, just know that the formula is how much you want to risk. If you are risking 20, you just say 20 divided by your stop loss pip. If your stop loss is 5 pip, divided by 5 times 10, that's one standard lot. In order to get the particular lot size to use for your trade. So divided by times 10, times 10. So let's go to our calculator. Our stop loss is 11. So let's do 11 times 10 first. 11 times 10. We have 110 here, and then we are risking how many? 100. So we are going to do 100 divided by 110. 100 divided by 110. Divided by 110. We have 0.99999. So it's just like 0.90. So how many lot size are you going to be using if you are going to take this trade? You are going to be using 0.90. 0.90. So this is the lot size we are going to be using to take this trade here. Now let's use the other formula. Now this is the main formula, but in a very simple way. If you know your lot size and your pip and how much they represent per dollar, what you simply do here in a very simple way is this. Since you know that you are risking just 100, you just do 100 divided by 11. 100 divided by 11. Let's go to our calculator. It's just very simple. You just go to your calculator immediately you want to take the trade. You do 100 divided by 11. How many do you have here? 9.0. Right? Now we all know that $9 is what? Is 0.9 lot size. It's a mini lot. This is a mini lot here. This is a mini lot here. If 0.1 is $1, then $9 is going to be what? 0.9. Now what do we have here? Our answer after we use the formula. The same 0.9. It's just very simple. Just try to understand. Let me delete everything here. You guys should write the formula down. Let me delete everything here. Let's do this again. See, have it at the back of your mind that $10 is one lot size. $10 is one lot size. $1 is 0.1 lot. Why $0.1? $0.1 is 0.01 lot size. So let me explain this first before we continue, so that we won't get confused. Okay, so let's start with one lot size. Now $10 is one lot size, right? So it means that $20 is two lot size, right? Are we following? So it's just like $20. It means $20 is two lot size now, right? $30 is three lot size. $40 is what? Four lot size. $50 is five lot size. $60 is six lot size. Like that till 90. $90 is 90 lot size. Right? Now, here now let's come down to mini lot. This is mini lot. Now in mini lot, $1 is 0.1 lot size. $1 is 0.1 lot size. Now $2 is 0.2 lot size. 0.2 lot. Are we following? Now $3 is what? 0.3 lot size. $4 is 0.4 lot size. $5 is 0.5 lot size. Like that. So now if automatically let's say now you want to risk $100 in a trade. If you want to risk $100 in a trade, in this trade, let me put the dollar sign. If you want to risk $100 in this trade now, and your stop loss, let's say your stop loss is down here. Let me draw this a bit down here. Your stop loss is 18 pip. So let me write this one. SL is for stop loss. Just know SL is 18 pip. SL is 18 pip. This 100 is what you want to risk. You understand? You are the one that know what you want to risk in your trade. So if what you want to risk in this trade is 100, and you now come here, you check down here, you see that your stop loss is what? 18 pip. 18 pip. This is very simple. What are you going to do? You open your calculator and do this. You say 100, which is the amount you want to risk, divided by what? 18. What do we have here? 5.555. So let's just say 5.6. So We have 5.6 here. $5.6. Now, how much is $5.6 in your lot size? Now, we know that if $1 is 0.1 lot, $2 is 0.2, $3 is 0.3, $4 is 0.4, $5 is going to be what? We have $5.6. It's going to be 0.56. You can add this 6 at the back there. So automatically you are using 0.56 lots. This is the lot size that you are going to be using. You just open your MT4 or your MT5 and you input this there, 0.56 lot. Now if this trade okay, let me take this one here and remove this one. So if this trade eventually hits your stop loss, let's say the market come to this place like this and made a sharp move, then came back and hit your stop loss, you are going to lose only $100 because you use 0.56 pip. So this is very simple, very, very, very simple, like very, very simple. You just have to understand what this table here, okay? You need to know what is your standard lot, your mini and your micro lot. In your standard lot 1, the volume 1, that is one standard lot, is $10. So if let's say you do a calculation and you got $10, for example, you know that you are going to be using what? One lot size. If what you are risking in a trade is 1,000, for example, 1,000, I'm risking 1,000 in this trade. So let's say I want to buy Euro USD from this place here, and my stop loss is at 10 pip. My stop loss is at 10 pip, or let's say my stop loss is at 100 pip, for example. Let me just say my stop loss is at 100 pip, and I want to risk $1,000 in this trade. I'll just do $1,000 divided by 100. You just open your calculator and you say 1,000 divided by what? 100. What do we have here? We have 10. Now we know that $10 is what? One standard lot. So automatically, if I want to enter this trade, I'll just put one standard lot. Look at it here, because we know that $10 is one standard lot. So once you do your calculation, any amount you get is in dollars. Okay, that's if you want to use this particular method, any amount you get is in dollars. So since I know that $10 is one standard lot, I'm going to be using what? One standard lot for this trade. I'll be using one standard lot to enter this trade. Are we following? So that is just it. Now let me go back to the former formula, the main formula to calculate your position size. So in case if you don't want to do this, what you will do is, how much do we want to risk again? We want to risk 1,000, right? And our stop loss is what? 100. This is the same example we just did now. So let me put the dollars. We want to risk $1,000 in this trade, and our stop loss pip is 100 pip. Our stop loss pip is 100. So this is the formula. Let me write it down again. The formula is this: risk percentage or risk amount. So our risk is 1,000, right? So let's just say risk amount all over, or divided by risk amount divided by, bring this here, divided by our stop loss pip, divided by our stop loss pip times what? Our position size, or you can just say one standard lot. I hope we are following. One standard lot is $10. So you can just say divided by 10 times 10, sorry. So risk amount divided by stop loss pip times 10. So how much do we want to risk here? We want to risk 1,000, right? That's if you want to get the particular lot size directly instead of using this first method. But to me, the first method is more easier, where you just calculate the amount you want to risk. That's 1,000 divided by your stop loss. If your stop loss is 10, you do divided by 10. If your stop loss is 5, you do divided by 5. Then any amount you get in dollars, you will now use the particular lot size that represents that amount. So if you get, for example, if you do your calculation and you get 5, that's $5, you now know that you are going to be using what? 0.1, because look at here, mini lot 0.1 is $1. So automatically you know that you are going to be using what? 0.5 pip. 0.5 lot size, sorry. So you just know that you are using 0.5 lot size to enter the trade. So, but if you want to now use the formula, you say the formula is this: the risk amount divided by the stop loss times 10, which is one standard lot. Okay. Let me remove some of these things so that, let me remove this. Okay, we are still using this one. So this is the formula here: risk amount divided by stop loss pip times 10. So how much is our risk amount? 1,000, right? Our stop loss pip is 100, and one standard lot is $10, which is 10. So any calculation, just divide it times it by 10. So you just do your stop loss times 10, then the risk amount, you divide it with the risk amount by the risk amount. So our stop loss is 100 pip times 10. So we do 100 times 10. What do we have here? 1,000. We have 1,000. Now, how much do we want to risk? We want to risk 1,000. So you just do 1,000 divided by 1,000. 1,000. Look at this. 1,000 divided by 1,000. It's equals to 1. Let me do this again. 1,000 divide by 1,000. What do we have here? 1. That is one lot size. So it's the same thing. We got one lot size at the first one. We still got one lot size here. Let's do one more example before we go forward. Now I want to buy let me delete all this. Now we want to sell. Our stop loss pip is 20. Our stop loss pip is 20. Please pay attention. This is the last example that I'm going to give. Our stop loss pip is what? 20. Look at it here. 20.6. So just take 20, and our account balance is 10,000. Let's say we are trading a profit account and we have $10,000 here. We have $10,000. Now we want to risk let's say we want to risk 1% of this $10,000. 1% of $10,000 is what? Is simply $100. $100, which is 1%. Okay, let me write it. 1%, which is 1%. Now our stop loss is what? 20 pip. So our stop loss pip is 20. Our stop loss pip is 20. Now, using the first method, what we are going to do in a very simple sense is this. We are going to say 100, which is the amount we want to risk. The amount we want to risk, which is 100, divided by what? 20, which is our stop loss speed. So you just say 100 divided by 20. 100 divided by what? 20. What do we have here? We have 5. So we have $5 here. 5. Now, in our lot size, 5 is what? 0.5 lot size. Remember, if 0.1 is $1, 0.2 is $2, 0.3 is $3, 0.4 is $4, 0.5 is automatically what? $5. Now, if you are not able to get that table on your head, any amount you get, you cross it over. So let's say if I have 5, now I just do this calculation, I have 5, I will automatically change it to 0.5. If I do this calculation, I have 2, I will automatically change it to what? 0.2. Let's say I do this calculation and I have 0.5 as my, like, $0.5, then I will automatically change this to what? 0.05. That is another way. But if you know your lot size, it's going to be very easy. Let me still take another example before I use the formula method. Now, if you are trading a small account and what you want to risk, let's say you have a $100 account, for example. Let me delete all this. So let's say, for example, you have a $100 account and you want to risk only $10 per trade. $10, since it's a $100, is small, so you want to risk $10. So you want to risk $10 per trade. Let's say you saw this sell trade on Euro USD and you want to take the trade, and let's say your stop loss is at 15 pip. Look at it, we have 15 here. Your stop loss is at 15 pip. So, and you want to risk 10. What are you going to do? You automatically come to your calculator and you do 10 divided by what? How many is your stop loss pip? 15. You just do 10 divided by 15. So let's type it. 10 divide by 15. What do we have here? 0.66667. So let's just say 0.6. 0.6. Now, $0.6 is what? Is our micro lot. So you know automatically that in your micro lot 0.1, in your micro lot $0.1 is 0.01. Look at it here. This is your micro lot. So $0.01 is $0.1 is 0.01, $0.2 is 0.02, and what do we have here? We have 0.6. That's it, automatically 0.06 lot size. It is as simple as that. Okay, so I go again for the last time. If you are risking $10 and your stop loss pip is 15 pip, you just do 10 divided by 15. You just open your phone calculator immediately. 10 divided by 15, we have 0.6 here. So 0.6 in our lot size amount, 0.6 is what? 0.06. Okay, so if you get 0.5, automatically you know that the lot size that you are going to use is 0.05. If you get 0.2, after you do your calculation, you got $0.2, it means that the stop loss, that the lot size that you are going to use is what? 0.02. So let me take one more again. I just want us to understand this part before any other thing. Let me take one more. If you want to risk $500 in a trade and your stop loss pip is in this trade and your stop loss is 15 pip, you just do 500 divided by 15. Let's go to our calculator. 500 divided by what? 15. What do we have here? 33.3. So 33.3, you know automatically that this is what? 3.3 lot size. This is 3.3 lot size. We got 33.3. 33.3. So this is automatically 3.3 lot size. Automatically 3.3 lot size. 30 lot is what? $30 in our lot size table is what? Is $3. Remember that one lot size is what? 10. Two lot size is 20. So $30 is what? 3 lot size. I hope you understand. So that is just it. Now, with this first example, let's use the formula one more time. You have $100 in your account. You want to risk $10 in a trade, and your stop loss pip is 15. What you will do automatically using the formula, you will automatically say, you first go to your calculator and you do 15. You do 15 times 10, which is our standard lot. If you do 15 times 10, any amount you get, you now use the amount you want to risk to divide it by it. So let's say 15 times 10. What do we have here? We have 150. So what you just do is you now do 10, which is this amount you want to risk, this $10 here that you want to risk. Remember that your risk amount is what? Is $10. Okay, so you just go to your calculator. Once you just, any amount that's your stop loss pip, you times it by 10, then you divide it by the amount you want to risk to get your accurate lot size. So okay, how many did we get? We get 150. So you just do 10 divided by what? 150. This is the formula. What do we have here? 0.06. That is the lot size that you're going to be using. That's if you want to use the formula. We got 0.06. 0.06. Now, but if you know your stop loss, if you know your lot size very well, and the amount each lot represents when it comes to dollar, it's very simple. What you just have to do is this. You just do the amount. I already did that before, so no need to go back. Let me give you guys another example. Now let's say in a trade you want to risk $500. And your stop loss pip, your SL pip is 15. What are you going to do now using the formula? I want to remove this. Let me go to the setting. Remove this border. Okay, it's not working. So what you do automatically, you are going to say your risk amount is 500, right? And your stop loss is 15. That's your stop loss. You just times it by 10, then you divide it by 500. So our stop loss is 15, right? We just do 15 times 10. 15 times 10, which is 150. So now you now do 500, which is the amount you want to risk, divided by 150. We have 3.3 lot size. You see that it's the same thing with what we got before, right? Remember when we used the other method, we got 33, then I now say 33 is automatically what? 3.3. So if you use this formula, it's just you are going to get the accurate lot size directly. So let me do another example. Now let's say I want to risk $150 in a trade. I want to risk 150. That's why I wrote 150. Please, this is the last example. I want to risk 150 and my stop loss pip is 20. My stop loss is 20. Now any amount, if your stop loss is 10 or if your stop loss is 100, now in this sense my stop loss is 20. What you are going to simply do first is you just do 20 times 10. That 10 there is standard. Okay, you just do 20 times 10. We have 200, right? Now how much do we want to risk? 150. What you now do is 150 divided by that 200 you got. 150 divided by what? 200. 0.75. Very simple. So how many lot size that you are going to use here? You use 0.75 lot size. 0.75 lot size. That's how to get your lot size using the lot size calculation formula. 0.75 lot size. One more example. In this trade now, let me take it to let's say your stop loss is 30 pip. You see 30 here. Now your stop loss is 30 pip, and in this trade now you want to risk $700. Let's write it down. 700. The first thing to do is, how many pip do you want to how many pip is your stop loss? We have 30 pip here, right? Now you go to your calculator. First thing to do is you say 30 times 10. You times any amount that is your stop loss pip times 10. We have 300 here. How much do we want to risk? We want to risk 700. So you now do 700 divided by what? That 300 you got. What do we have here? 2.222. So automatically you know that you are using 2.2 lot size. Automatically you are using 2.2 lot size. 2.2 lot size. Okay, so you can either use this formula method or you use the other method. Let me write the formula down one last time. I need to remove this border. The formula is this: risk amount divided by your stop loss pip times 10. This is the formula here, so you can write it down. The first step is you calculate, you first take your stop loss pip. If your stop loss is 30, you go to your calculator and do 30 times 10 first. Any amount you get, you will now put the amount you are risking. If it's 700, if it's 500, you now say 500 divided by any amount, by what you got. So if your stop loss is 17, you just come here and say 17 times 10, which is 170. If your risk amount is $10 or $20, that particular amount, you do what? Times it. You divide it by the 170 you get here. Okay, so that is just all about this. So now let's talk about our risk to reward ratio. Now risk to reward ratio is a measure of how much you are going to gain in a trade by how much you are risking. I will not talk much on this. This is what it is here. Now if you are shorting this trade, let's say for example you are shorting from here and you are targeting down here. Now if you look inside here, you see where they write risk/reward ratio 5.7. now it means that any amount you are risking here, if this market eventually hits your take profit, you are getting 5 of what you risk by your stop loss too at the same time. So let's say your stop loss is at 10 pip. You see, after this bracket, you see where they wrote 10, and at the middle here, risk to reward is 6.8, right? And your target here after this bracket, you see where they wrote 70.8. Now it means that any amount you risk, you are getting 6 times the amount. So let's do the simple math. Let's say you are risking what? $100 here. $100 in this trade. Now, and your stop loss is 10.3. Right? Now, it is very simple. Just do 100 times 10.3. No, sorry, I think I made a mistake here. It's supposed to be 100 times 10.3. Okay, this one is in pip. Sorry. So, let's say at this junction now, you are risking $100 in this trade now. If this market eventually hits your stop loss here, if it hits your stop loss, you are losing 100. But if it hits your take profit, you are getting 60.8. So what you should do is this. How much are you risking? 100, right? 100 times 6.8. 6.87, sorry, times 100 times, oh, okay, 100 times 6.87. That means if your trade eventually hits your take profit, you are getting $687. But if it hits your stop loss, then you are losing this 100. So that is just what risk to reward is. Let me get another example. Let's say you are buying from here to this place. TP is at 70 pip and your stop loss is at 20 pip. At 20 pip, 20.1 here, and you are targeting 70 pip. Now your risk to reward ratio is 3.5, right? Now if you are risking $10, for example here, $10, it means that automatically if this trade hits your take profit, it's going to be 10 times 3.5. That means if this trade hits your take profit, you are getting what? 35. So this 3.5, it means that any amount you risk here, you are getting times 3.5 of it. I don't know if you understand. If your take profit is at this level and your risk to reward ratio is 2.5, then you will say that your risk to reward ratio is 1:2.5. 1:2.5. So any amount you risk here, you know that you are getting times 2.5 of it. That is just what this risk to reward ratio is. So if I'm risking 1,000 here, 1,000, it means that automatically I'm getting what? 2.5, right? If you do 1,000 times 2.5, you are getting 2.5. 1,000 times 2.5, you're getting 2.5 automatically. So any amount you are risking times your risk to reward, that is what is going to determine how much you are going to get. So but it is more safe as a trader, especially if you are both a beginner trader to advance, to take at least 1:2. So if you are risking 1, you know that you are risking 1 to get 2, right? If your take profit target is 1:5, then you know that you are risking 1 to get 5. If you are risking 100, you are getting 500. If you are risking 1000, you are getting 5000, like that and so on. So that is just what this risk to reward is. So the next thing we'll talk about is money management principle. We are now in module 5, money management principle. Now in money management principle, where most traders get it wrong is this: you need to have a fixed percentage risk. You need to have a fixed percentage risk. In forex trading, there's what they call the golden rule, where you have a certain amount you risk per trade. So now, number one, you need to have a fixed percentage that you risk per trade. A fixed percentage. You should risk at least 1 to 2% per trade. So let's say you are trading a $1,000 account. $1,000 account. Now, 1% of 1,000 is what? It's $10. You just risk 10%, $10 per trade. That is 1%. Or you risk 2%, which is $20 per trade. Especially if you are a beginner trader. Now, and another thing is, as a beginner trader, you should first have a fixed lot size. You should have a fixed lot size for beginners. So if you are going to be using just 0.5 lots, then you know that, okay, I'm using 0.5 lots and my stop loss pip, I'm not going to use more than 10. So all my stop loss, I'll just be putting my stop loss as 10 pip. Okay, so the next thing I want to talk about is increasing your lot size. You should only increase your lot size when your account has started growing. Let's say you have $1,000, and since when you are trading this $1,000, you are using only 0.01 lot size. Now when you grow this account to 2,000, then that is when you can now decide to use 0.2 or 0.02 lot. You understand, like that. So now next thing is drawdown control. You should stop trading or reduce your lot size if your account is down on 100, on 10 or 20%. So let's say you have this $1,000 account and you already lost 10%, that which is 100, and your balance is 900. You can choose to reduce your lot size to reduce your risk and your mental state. Okay, now let's talk about leverage and margin management. Now, leverage allow you to control large position. So we have 1:100 leverage, 1:200 leverage, 1:300, like that till unlimited. Now, for example, if your account balance is 100, especially when you are creating an account on any broker, they usually ask you to select leverage. Now, if you are trading a $100 account and you are using a 1:100 leverage, you went to your leverage setting and you selected 1:100. This will allow you control trade of $10,000 or 10,000 worth of position. Sorry. Now at the same time, as your leverage is very high like this, that you can control large position with your $100. If your leverage is high, you can even open a trade of 1 lot size, and at the same time it can blow your account very quick, and it can make you money very quick. Now for you to be able to manage your capital well, you use a very low leverage of at least 1.50 or even lower. Okay, so next let's talk about emotional and psychological control. Now this is where the golden rule comes in. You just write this down and set it as a rule that you will follow in your trading. Okay, never move your stop loss, open it will return. Avoid revenge trading. You traded today, you lost a trade, tomorrow you lost a trade, and next tomorrow, or let's say you took a trade this morning, you lost it, in the afternoon you still lost it, in the evening you want to recover those money, you want to revenge back. The more you try to revenge, the more you keep losing. So avoid revenge trading, and also always journal your trade, and don't risk more because you are overconfident. I've done that countless times where I receive signal from big bigger traders, especially when I was learning and I decided to risk everything and I still end up losing the money. You cannot hold the market. So you should make sure that you accept that losing is part of the game. So next is practical application and plan. So you should post the video or screenshot this. I also send this to the group so that you use this to build your plan, your risk management plan. You just write it down. Okay, account size $2,000, risk per trade 2%. Okay, maximum open trade 3. So if I open 3 positions, I want to put another one, or 3 different currency pair, I want to put another one. Total risk 6%. Your stop loss, can put your stop loss to be between 10 to 20 pip, between 30 to 50 pip. Your target minimum is 1.2 RR. Okay, if your target is even 1.5 or anything, but you know that at 1.2 risk to reward, you take your partials there. That's your minimum. So if you want to enter a trade and it's 1.1 risk to reward, don't enter that trade. So you just set this as your rules. Daily loss limit 5%. In a day, if you lose up to 5% of your account, I won't trade again that day. In order to control and manage your emotion. So next is weekly drawdown limit 10%. If you have let's say Monday you lose 5%, Tuesday you lose another 5%, then you won't trade that week again. You leave it till next week. So that's a good way to control your emotion. Okay, so last we'll talk about the model check 10, checklist and habits. You see these 7 different important things I wrote down. You should write it down. Make sure you use stop loss in every trade. Calculate your position before entering. Never risk more than 2%. Okay, if your rules say that your risk to reward is 1.1:2 minimum, then you follow that. Now, don't trade emotionally. Take profits consistently and review your trading journey weekly, your trading journal weekly. So let me talk about take profits consistently. The market tap you in here, give you up to 1:2. You should at least, anytime you see 1:2, take 50% of your profit. Let's say you risk 100 here. At 1:1, you are making 100. At 1:2, you are making 200. Take partial profits here. You should take partial profit at $100. So you just take partial profit 100. In case if this market comes back and take you out like this, you will lose nothing. Okay, so make sure that at 1:2 you take partial profits consistently. It's going to help you. So that will be all about this risk management topic. We are still going to talk more on other topic, and then we talk about trading plan. But for now, you should make your risk management plan. Okay, in trading plan is not only about just rules and all of that. In trading plan, they have risk management plan, trade management. We have different plan, including psychological plan. Part of my psychological plan is every day I must listen to maybe a spoken word or a video, or even read something for 5 minutes that will boost my rate of thinking, boost my rate of reasoning for that day, every day. So even if I take a loss, I know that okay, there's hope, you know, something like that will really help you to trade fine. So that will be all about this topic. Have a very beautiful day and take care of yourself. I love you guys. Bye.